be literally us trying to figure out what is bonds and what are bond deals basically. Um, so I will just make this presentation initially with the same feeling that we may all be equivalent to a six-year old, that we don't know anything what is bond, and even this is a new subject for me. Although I knew the basics of it, but in all the complicated terms start coming in, it's easy to get run over with various concepts. So I'm pretty sure everybody is knows at least what a bond is, not the actual definition, but what an actual bond does. Yeah, I'm expecting people to speak.
Yep.
Yes.
Yeah. So basically, a bond is a document which is like a IOU note, which basically is issued mainly by the governments and the companies to various investors or public who buys their bonds. So the bonds, unlike a real loan, doesn't have to be repaid back in an equal monthly installment. It basically they pay the interest rate, or what is known as a coupon, every year to the bondholders, and in the end they get back their principal, or whatever was the initial capital that they paid to buy this bond, pay the face value of bond. And this is how a US Treasury bill looks like in paper form. And I just took an image from a very old Treasury bill back to 1970s. So US Treasury bill is the most commonly used term when we say T-bills or yields, because this is the largest circulating paper in the world in the money markets, and literally every pension fund to different, even the countries, different sovereign governments buy US Treasury bills, because unlike retail people or small investors or everyday people, governments and the big companies can't just keep the money in bank and expect to have some interest. So, and also most of the countries may plan around their foreign exchange reserves, so they might end up buying US Treasury bills. So when I say what is a 1 year bond, it's a bond which matures in 1 year from time frame. So you could expect 1 year bond to have a lesser interest rate, because there's a lesser risk, because you are going to lend the money for just 1 year, so you don't have to worry about the longer term risks, like what could happen to the economy, whether the government will be in a position to pay back the money, because literally we're not talking about US government, but let's say you ended up buying a bond of a country like Argentina or Venezuela. You don't know whether the country will be in a solvent position to pay back the money. So similarly, a 30-year bond, because the term is so far, you will have more interest rates, and because it's considered more risky, because you have to consider a lot of things like the inflation and what could be the real effect of um, government borrowing in large numbers, and whether it will be in an ability to pay it back. So the bonds basically have what is called as a coupon rate, which is what I mentioned, which is the interest that is paid out on the face value of the bond every year. For example, if $1,000 bond has an annual coupon rate of $60, that means the bond's yield is 6%. You divide the coupon by the bond price and into 100, and you get 6%. So when I say a bond has a yield of 6%, means it's giving $60 on the face value of $1,000 bond.
I already asked my first stupid question.
Mm-hmm.
On the previous slide, if we talk about relatively strong economies, will there still be a large difference between the 1 and 30-year bonds?
Technically, yes, because I'll tell you why the bonds are slightly different from a traditional loan. Because we may be thinking, what's a big difference between 1.5% or to 2%, or even 2% to 2.25%? For a bond market, that small 0.25% is a big move. I'll tell you why in the slides ahead. But most of the bonds, if you're going that large of a time frame, generally they do carry higher risk, and hence you would expect them to command a slightly higher rate than what a 1 year bond or a 2 year bond or a 6-month bond would have. and this is technically of like a stable government, which is like considered to be investment grade bonds. So there are different credit ratings for these bonds depending on their ability to repay the money and their present debt that they carry. Generally, United States of America is considered to be the world's most one of the most powerful countries, and will always have an ability to pay back. So these bonds will be what is known as an investment grade bond. But then on the other hand, you could have countries like Argentina, Venezuela, Italy. Yes, even Italy. They were all classified as junk bonds uh, because they had so much of debt and without any reasonable hope that they would be paid back over time. Because even in Europe, I think Ireland itself, back in 2008 banking crisis, was at a scenario where bondholders were ready to accept the fact that they may not get 50% of their money. So depending on different time scenario, I mean, depending on the shape of the economy, these bonds may get rated in a different way. So, and what is similarly what is known as a dividend yield for a stock, where you basically divide whatever annual dividends that the share pays out divided by the stock price, you get a dividend yield. Bond yield is basically whatever is the annual coupon. You divide that by bond price into 100. So when I say how does interest rate affect a bond price, since a bond pays a coupon initially, let's say you bought the bond for $1,000 and that it had a coupon rate of $60 every year, so the yield was 6%. Now if the bond price falls to $950, the yield is no longer 6% because you're still getting that coupon of $60, but you're getting to buy the bond at $950, so yield has actually now gone up to 6.3%. And if the bond price falls to 900, the yield is now no longer the same 6% because you only have to pay $900 to get the $60 coupon, so which is basically your yield is 6.6%. Because even though you're still getting your 60, at the end of this bond, at the end of this term, you're going to get back the $1,000 face value and whatever coupon you would have received in the life of the bond. This is why even a small interest rate change can push the price of the bond up or down. When one thing you need to remember is when I say bond yield is going up, that means the price of the bond is falling. And if the price of the bond is rising, the yield will go down. It's an inverse relation. And feel free to ask questions in between, because I want this to be as interactive and as possible, and you can actually add some points as well if I missed out something. And this is how a normal yield curve is supposed to look. The longer the maturity, the more the yield. Basically that should give you more interest rate if you're holding a bond which is going to mature in 30 years from now, versus something like what you would be getting for a 1 year or a 2 year or a 5 year bond. So this is what a normal curve is supposed to look. So in a healthy economy, you will have 1 year bonds and 5 year bonds having lower interest rate than 10 year bonds and 30 year bonds. However, this curve will change its shape during different phases of economy, which we will see what those different phases could look like and why they do happen. In this case, let's assume the examples of Papa Turtle and Turtle Buffett. Both of them buy bonds, and just for the purposes of explaining this, both of them buy a bond which having the same yield. Technically, this was very rare. Generally, a 2 year bond will carry lower interest rate and a 10-year bond will carry higher interest rate. But just to make it simple, for this example, I'm taking that both the bonds have 2% yield when they bought the bond, and let's say both of them paid $1,000 each to buy this bond. They bought the bond at face value, and let's say both of them buys this. Papa Turtle has a shorter term view. Turtle Buffett has a longer term view, so he buys a 10-year bond. So both of them have a different investment objective, and say 1.5 years from now, JPO, the Federal Reserve, starts issuing higher interest rate bonds. Let's say the interest rate went up by 0.5%. Now you might say 0.5% is just a tiny percentage move. How much? It's not going to affect um, people by much. That's not true. We'll see from the example why. This is how Papa's Turtle's bond will look when already 1.5 years or 18 months have passed. When he initially bought, the face value of the bond was $1,000, and after 1.5 years he still has 0.5 years left, which is basically 6 months, and the initial coupon rate was 2% when he bought the bond. So the bond is going to give $20 each year. So the present value of the bond, because the interest rates went up by 0.5%, now the bond price has gone down to 997.55. Now Papa Turtle has two options. He can say, well, it's only another 6 months, I'm gonna hold on to this bond and then move on to a better bond, because I don't want to book a loss on my bond by selling it at $997, which is still a good 3% loss, 2.5% loss. Or he can book that small loss today and say, you know what, I'm going to move on to a better bond, because I think this this opportunity is not going to last long. Whereas, let's see how the same 0.5% move affects Turtle Buffett's portfolio. Now, Turtle Buffett's portfolio bond is expiring in 10 years, so he still has 8.5 years to maturity. And when the price goes up, the interest rate goes up by 0.5%, the bond price has declined to 962. So obviously, if he wants to get out at this point of time, he will be taking a big loss of close to 38% on his portfolio. The only way he gets on without booking this loss is taking a lower interest rate and staying in it for the next 8.5 years. And every time the interest rates moves higher and higher during the course of 10 years, the bond prices decline. So the bond prices falls if the interest rates goes up, because you, when you bought the bond, had a lower interest rates, and now to adjust for the new interest rates, the bond prices will go down to adjust for the new interest rates. So because somebody buying the bond today is getting a higher interest rate, so the prices goes down to adjust towards that interest rate. So this is the Excel sheet that I have sent you that you can use to calculate. Only changes value where there's a star mark given, and don't touch yield to maturity or this column. So you can just put in what the initial one face value was and the time left and the coupon rate. You'll get different values for different durations. So this is how a small percentage move in interest rates could make a big dent on somebody's portfolio. And this is the reason why companies, even though from a general point of view, bond markets may look really boring, because something is yielding 0.5% interest or even 0% interest, or in some cases even negative interest. Like if most of the European countries have negative yields, like Germany, Sweden, and all these countries have bonds with negative yields. So basically you lose money every year that you hold on. Why would they buy bonds where they lose money? It's interesting, but that's a different part of the discussion that we can look at it later. Is this example clear as to how a small 0.5% move in the interest rates can affect somebody's portfolio in a big way in terms of bond portfolio?
I have a quick question.
Yeah.
And first, thanks for confirming that Buffett always takes more stupid trades than I do. The question that I have is how did you come about the discount rate per period of 2.5% here?
That is I'm not taking that. That's a calculation. Say the price dips to this, the bond yield now moves to 2.5%. Get it?
Yeah, in that initial bond, Papa, you are receiving 2% coupon for your bond. But then general interest
Mhm.
rates went up by another 0.5%. Isn't that what you said, Ninja?
Yes.
So any new bonds issued by the Treasury would have to reflect the interest rate going up, which would mean then that your interest rate would be a minimum 2.5% on your next bond. Is that a correct interpretation, Ninja?
Correct. And the market will adjust the
Okay.
present, all the bonds that are there at the market right now to reflect the new interest rates. Because why would anybody
Got it.
buy a
Thank you.
bond? Because you need to understand, why would anybody buy a bond which is giving 2% when they can literally go and buy another bond which is giving 2.5%. So there's no separate series where it's having a higher interest rate and the separate series having a lower interest rate. All the bonds that are there in the market reflect their prices to adjust to the new interest rates.
Yeah, and that's the present value of, yes, exactly.
Yeah.
So the present value of all bonds then is the equalizer depending on the interest rate move. It levels the playing field.
So if bond prices goes up, your yield goes down. So basically, the interest rates has gone down. If the interest rates is dropped, your bond prices will go up upwards of 1,000 to reflect for the new interest rate. We can play around with the Excel sheet towards the end to see how even a small minutest of the differences will make a big impact for somebody holding a 30-year bond, which is where most of the pension funds and big institutions and governments would be putting bulk of their money into.
Mhm.
Is that clear? Anybody has any questions on this particular instance if they could not understand what I just mentioned? Take that as a no.
Maybe another one. And if this is a bit redundant, then just cut me off.
Mhm.
But in the Excel, I see there's a option of annual percentage rate or effective annual rate. What is the difference?
You mean the yield to maturity type?
Correct.
Don't stress on that right now. We don't want to make it more complicated. But let's assume you keep the thing at annual percentage rate.
Oh.
Yeah. So now Turtle Buffett, if he decides to get out of this portfolio, has taken a hit of 38%. So that's what a small 0.5% move in the interest rates is doing. So now we are having a situation where the yields are rising. So what does that mean? If yields are rising, what would be the bond prices doing?
It'll go down.
Exactly. And what happens when the bond prices go down? Why should stock markets go down when the bond prices go down?
Because the capital will flow towards the bonds.
That's one theory, yes. That now a lot of institutions might find it more lucrative to own the bonds because the yield is much better. And another explanation is that the bond investors, because typically a pension fund would have majority of its portfolio in fixed income and bonds, like almost more than 60 to 70% in some cases. When these guys have a huge loss on their portfolio, they will try to book profit in places where they have good profit, which would also explain a possible reason that the stock sell-off is happening, because these guys are booking profits in order to cover for their losses in the bond portfolio.
So do I understand that correctly? That a institution can only book profit once they close a outstanding stock or whatever it is.
Yes. Otherwise,
And then
otherwise it would be just a fair value treatment. Depending on most accounting treatment would be just it will not, the profit is not realized for tax purposes unless it's booked. Well, the NAV of that particular fund or pension fund would be still up, reflecting the changes in the stock portfolio, but in terms of accounting, it's only booked when they sell it for the balance sheet purposes.
So I get that they then close their outstanding equity positions, but what will then move them to actually get into the bond market? They don't have to do that then, right?
They don't have to, but if you look at pension funds, will have to plan from a slightly longer term point of view unlike most of the other traditional investors, because now most people buy stocks, like most of the big pension funds buy stock not with the purpose of having capital appreciation. Obviously capital appreciation is good, but you can't really plan that for something like say 1 year or 2 year with absolute certainty. So these guys buy stocks where they have high dividend yields, right? So when, to make it simple, S&P 500 has now a dividend yield of 1.46%, and now the bonds are giving you a yield slightly higher than 1.46%, and bonds do not carry the same risk as stock markets. So if I was a very conservative fund manager managing a huge pension fund, I would say I don't want to take the risk that the stock prices might not stay at the same levels, because we have had a very good couple of years for the markets. Now I want to take some money off this and I want to allocate it towards the bond, because now I'm getting a better yield and I'm having more safety of my money.
And for me, $1 million question, and it's probably not an easy answer, is how do these institutions evaluate the risk of a bond?
There is no bond. The risk of a U.S. Treasury bill is almost assumed to be zero, because it's the U.S. government, and if U.S. government is not in a position to pay back the money, then I don't know which government can. So U.S. Treasury bills or any sovereign Treasury bill of a very good economy is considered to be zero risk.
So is it a fair statement that anybody that keeps their savings in an savings account with 0% interest, which is largely the case at least in this side of the world, it's quite a stupid thing, given that you could also invest in bonds?
Yes, but unlike a small investor do not have the same access as to what the bigger institutions would have, because some of the entries scenarios would be completely different, or the options available to a small investor could be filled with various various things like a fund charging excess management fees and so on. So but this is more largely kind of a compulsory thing for large pension funds, because their investment memorandum will have mandatory criteria that you cannot park more than 20% of your you can only park a maximum of 20% of your total assets in stocks. Remaining has to remain in money market funds. So these guys manage the risk of interest rates going up or down with the inflation risk by moving around with different time frame. So that you will slightly understand as we go on, and to see why the bond prices go down and why the bond prices go up, or why investors jump onto the bond prices even when the interest rates are going down.
Oh.
So like you said, you saw the yield curve. This is a normal curve, but this curve can also become flat, where a 1-year bond could be getting the same interest rate as a 10-year bond or a 30-year bond. Or it could be a scenario where the curve gets inverted, where you're paying more for 1-year and 2-year funding than what you would pay for 30-year and 10-year funding. So these curves have different meanings. Generally, normal is said to be the best curve. Flat is a kind of sign of worry for the market that you could be nearing a recession. And this inverted curve, if history is anything to go by, after an inverted curve, there has always been a recession. At least in the past 100 years there has been, whenever the inverted curve has occurred, and afterwards it has started going up again. So the most talked about yield curve is the US Treasury yield curve, and when they look for this, they look for a reference to the difference between what a 10-year Treasury is giving minus the 2-year Treasury bills. So basically you minus the yield difference between what a 10-year bond is paying and 2-year bond is paying, and then you form a curve to see how this curve has performed in relation to the market. So yield spread, basically that's the difference between the 10-year bond is yielding and the 2-year bond is yielding. Fed has an authority on to make changes on the left hand side of the curve, which is the short term. But they can't really do much to change the curve or the pattern or the behavior of how a 10-year or 30-year-old bond would behave, because this side of the curve can be influenced by major investors and all the pension funds and all the large banks and institutions buying longer term bonds. Why would Fed want to regulate this side of the curve? Why would they do it? Does anybody know? When I mean play around this side of the curve, meaning why would Fed step in to regulate the short-term rates? Anybody?
Is it linked to the cost of capital? Is it linked to the cost of capital of financing corporates?
Could be, but why would they step? They are not really bothered about what corporates are doing. They're worried about the general health of the economy and the economy as a large. Why would they want to tinker around with short-term rates?
Well, if short-term rates goes up, the cost of borrowing for corporates goes up, which means that they making as much profit then. So it does affect the health of the economy.
And their balance sheet as a result, no?
Yes, but both are correct to a point. But the main reason why Fed would step in is to stop inflation from going into a territory where you're going into excess inflation category. Because if there's too much money in the market, people can borrow freely, and the banks start lending freely, and all the money is chasing similar assets, and you have real estate prices going to ridiculous extent. Then you have all the stock markets going up. So they don't want to have a scenario where there's excess inflation. Inflation is good to a certain extent, where the prices are going constantly every year. For this, the Fed says that their target is 2% inflation, because you don't want a scenario where the prices are going down, because if prices are going down, which is called as deflation, your wages will go down, your property prices, everything goes down. It's generally bad for the economy. Whereas inflation, moderate inflation is good. So when Fed thinks that there's too much money in the market and the prices are rising too fast, they would put a halt to this by increasing the short-term interest rates. So a Federal Reserve or a central bank of any country might come in and say, we're going to raise the interest rates in the short term. So when that happens, they hope to put a stop to this excess price rises everywhere. So which might coordinate with stock markets falling slightly, real estate prices adjusting itself, and so on. But they can't really do much to change the scenario for how these longer term bonds would behave.
And why can't they influence the long-term bonds?
Because their primary view is to change the interest rates in the short-term scenario, but they're not going to come and say that we're going to keep this interest rates for the next 30 years. So what happens in the longer-term time frame bonds is going to be dictated by investors on what they feel where the economy is or how the economy is doing. Because if I have a feel that the economy is going to drop from here, I will go and buy long-term bonds, because if the economy is going to drop in the coming years, the interest rates have to go down. And if interest rates eventually interest rates will go down, and stock markets will go down, and everything else will come crashing down. So the only safe haven for me is these longer-term bonds, because I know at least today, at today's rate, I'm getting 2% interest. So I can plan my investments in such a way that I'm going to park all my cash into 10-year or 30-year-old bonds. And when everything is safe and I feel the economy is coming to a stage where it's going to pick up, then I will come out of my bond portfolio and pump that into stock markets.
Cool. And when people trade bonds, do they actually go in and buy or sell the bonds, or do they again use derivatives?
Like stock markets, bond prices or bonds are also traded over the exchange and over the counter, where the big banks trade among each other. But you as an investor, certain platforms do give you the opportunity to go and buy or sell these bonds, and there are also bond futures and other derivatives product on all these different bonds. The people can bet whether the interest rates are going to go up or interest rates are going to go fall. So there are different derivative products, and like unlike stock markets, the bond market is several times larger than the stock market itself. And with the derivatives, you can see the exposure is much higher. But obviously, this is a place where all the big banks and the big boys play. It's not generally a place where I would expect investors to keep buying and selling bonds.
Cool. And last question. How do they typically? What signals or metrics do people typically look at when it comes to evaluating whether it's a good time to buy or sell?
When I explained if the bond prices will fall if the interest rates go up, and if interest rates are going to fall, the bond prices go up. And if I'm an investor, I know for a fact that because the governments around the world are printing massive amounts of money, and they're going to borrow large sums of money, because right now we have economy almost coming to a heel everywhere around the world, right? So our government is not going to increase the interest rate anytime soon. So if government is not going to increase interest anytime soon, because obviously it hurts their own balance sheet, because now they have to pay more interest on whatever they're borrowing. So I know for a fact that they're going to keep it at these rock bottom levels for a long time, and I know there's not going to be an interest rate rise anytime soon. So if I'm getting the yields that we are getting right now, I would go and buy the bonds.
Cool. Thanks.
Why would investors buy too many long-term bonds? They may expect, like I said, future interest rates to fall or not increase. They may expect other investments to perform poorly. Like right now, a lot of investors, professionals have started coming out and voicing their opinions, saying that we are in a bubble category where you have kids doing TikTok and coming on various social media and saying buy this and buy that, where there's absolutely no business. Where you have likes of cryptocurrency and everything going to massive price rise. They have a fear that we are in a bubble category and we may not be doing too well from another investment point of view. So if I have that fear, like if I'm an investor that will have to plan for a lot of other things, I will take out most of my money from stocks and put it into bonds if the yields are very interesting at the moment. And basically you expect the consumer demand is going to slow down in the near future, and debt obviously is rising in massive levels like never before. All the 40% of the dollars that are ever circulating will be made this year and the last year. So you know the amount of money and the borrowing that has gone through in the market in the last 2 years. So this would be one of the main reasons why investors would go and buy long-term bonds, especially 10-year and 30-year-old bills. If the situation doesn't improve, now the curve that we saw, which was a normal curve, was like this. Now the curve will flatten. How will a curve flatten? Is basically when the 10-year bond yields come down to same extent as the say 2-year bond yields. Why would this happen? How would a 10-year-old bond yield come down so much?
Is that because the short-term interest rates go up, Ninja, and that it erodes the value of the longer-term bond prices?
No, in the case that everything is the same, government is not touching the interest rates, but why would the yield curve of a longer-term bond come down?
I would say maybe on the pricing or of the bond, or that could be a result also on the future outlook people have on the next 10 years.
Yeah, let's see, there are only 100 bonds. There's only so many bonds available, right? Now, if the demand for these bonds pick up so much that I'm selling all my other investments and I'm going and buying these long-term bonds, every time I go and buy, because then the massive number of people buying these bonds, they're not gonna get it at the same price that a guy who bought it 2 months ago would be getting, because now there's too much demand because everybody's rushing into bond markets. So when they pay more price for their bonds, the yields on those bonds go lower and lower. And as more and more people get in at, at the higher price, they're already getting lower yields, and they've come down. The yields would come down with that. And why would they buy something like that? Because they're rushing to safety. They're ready to accept a lower return just to ensure they have a long-term source of interest, or even to protect their capital. And as this curve flattens, it makes it difficult for financial institutions and can make the access to capital a lot tougher, because people are exiting. They're no longer interested in buying new fresh stock offerings, and as a result of this, the stock market is falling, because you have more and more flight of investors selling their stocks and jumping into long-term bonds, because they think that we could be entering a recession stage. Like I said, bond prices go up, yield comes down. Bond prices goes down, yield goes up. When there's too many people selling bonds and people are no longer interested in holding bonds, the yield goes up, which is what seems to be happening right now. Otherwise the yield won't go up. It's a kind of a tricky scenario if you consider. So why are people freaking out because the yields are going up? Because it's a good sign. It generally is a good sign when the yield goes up, because people are leaving bonds and getting into other investment classes like stocks and cryptocurrencies or real estate or any of these things. But the problem is, if this yield rises too fast, that's where the problem is, because now there's too much massive price inflation. There's an inflation risk that is happening. Generally, whenever this would have happened in the past, the government would have stepped in and raised the interest rates. But right now you have the US Federal Reserve stating that they're not going to touch interest rates anytime soon. But at the same time, you also have a fear that the government will be forced to increase the interest rates, because there's no other go, because of the yields rising so quick. And this is how an inverted yield will look, where a 10-year bond is having a lower interest rate than a 1-year bond. When there's too much investors jumping and buying the longer term bonds so much that the yields have dropped so much over the long term, because they're not really confident about the short term prospects, because they feel there's excess risk and we could be immediately entering a period of recession. I know I told this would be a short meeting. I'm looking at the watch and it is almost gone 5 minutes till 5. I hope it's okay, and I hope to drive my point soon. I hope it's okay if I continue on.
Yeah, fine. I'm enjoying this.
Yep. Cool. So why is this curve watched so closely? It basically, like I said, you can tell what the investor is expecting by looking at his the yield curve, because whether people are jumping onto the bonds or people are exiting from bonds and jumping onto stocks. Because if history is to repeat, obviously there's no proof that this is going to repeat, although it has happened 3 times in the past. This time could be really different, because you have the Federal Reserve and the US Treasury going hand in hand and saying we are not going to do anything to affect this bull run. Basically, they're not saying that directly, but they're saying we are not going to increase the interest rates, which I think is true, because if they increase the interest rates, look at it this way, it's going to affect them more than anything, because it's not just inflation that they're worried about, it's their own balance sheet they need to be worried, because the governments now are the largest borrowers in the history. Like, if you've crossed the debt levels in such an extent that we are going into what is known as really crazy levels. Nobody knows whether all these debt will be able to be paid down, because they just keep rolling this debt from one generation to the next generation, and some generation maybe the next one is going to pay the cost for all the borrowing that we're doing. So, like obviously, like I said, Fed influences the short-term rates because they want to. Earlier, this would have been true, where the Federal Reserve was, most central bank around the world would have stepped in if there was a risk of inflation. They would have gone to curb that inflation risk. They would have gone and raised the interest rates. But right now, we are in that catch-22 situation where the economy is kind of screwed. But you have all the asset classes which are showing inflationary risk, like stock markets and real estate. Even real estate prices are picking up, barring commercial real estate. The residential property prices seems to be going up rather than down, with all the pandemic and the lockdowns that we have had so far in the last 1.5 years. So in a booming economy, Fed increases the interest rates to reduce inflation stick. When the economy is going through a recession like we had after 2008 financial crisis, the Fed generally lowers interest rates to encourage borrowing so that people will not save money but rather go and spend money, and also they hope that banks will lend more people more money. And bond investors, like I said, why would bond investors get in when the interest rate is zero or near zero? It's because the bond prices move in such a direction that for a small 0.05% to 0.10%, the bond prices could jump in different manners. And if you add all other things like derivatives, like what we do, put option and call options, and the futures that you could use to buy the various bonds, it makes a very different, very interesting calculation. So a lot of bond investors try to bet that this is the time now the Fed will try to raise interest rates, because yes, there's huge inflation risk and they can't let it run in the same fashion. So, like I said,
sorry, did I get it correct? If they raise rates, the price of the bond will go down.
Correct. If they raise rates, because the price of the bonds will go down, because it will adjust to the new interest rate. You get it? Because $1,000 bond, which you are getting 2%. Now let's say if they raise the interest rates to 4%, your price is going to fall, because the coupon still remains the same, whatever you're getting on your existing bonds, but the price will adjust itself so that it's equivalent to you getting new 4% yield, or whoever the new guy is going to buy into bonds will be getting 4%. Because in a normal scenario, if you go and sell your bond, say you bought a 10-year bond and you want to sell it to me, I'm not going to buy it from you for $1,000. I will say the present interest rate is 4%, and your calculation of me trying to sell it to me for $1,000 doesn't work anymore, because I could just go and buy a new bond in the market and I could get it for a bond which is paying me $40, but your bond is only paying me $20. So after doing my calculation, this is the discount value that I've arrived at, so you need to pay me $990 or $980. That depends on the maturity. So the bond prices goes down, because bond is traded in a similar way what we trade shares. So it's not a thing where you go to the bank and say, you sign an application and say, please give me the bonds. The bonds have the same liquid markets that we trade, like stock markets, where people can buy and sell bonds, and there is a bid-ask spread. If the interest rates rises, the guy trying to sell will have to sell it at a lower price, because there will be no buyers for the bond at the same price. It can take a while to get used to this fact that interest rate goes up, bond prices fall, interest rate goes down, bond prices rise.
And just another maybe stupid question, but if the interest rates are at an all-time low, would it make sense to short bonds?
No. I'll tell you why. If you look at countries like Germany and Europe, the interest rates are negative 0.25% to 0.3%. So who says zero is the absolute place where it only can go to zero, and then only it can go up from there? Because interest rates can even go lower than zero. Because if interest rates goes lower than zero, your bond prices will keep going up.
Okay.
And yes, for normal people like you and me, we won't have a problem keeping money in the bank. Because if bank says I'm going to give you negative interest rate, you'll say fuck off, I'll keep my money somewhere else, or in my own house, or in my carpet, under my carpet, or locker, or whatever. But if you are somebody having billions and billions of cash, you have to keep it in bank, or you have to keep it in a place. So if the bank says I'm giving you a negative and you need to pay me money to keep your money, you will start looking for different options, like bonds wherever there's a positive yield, or say even riskier like stocks.
Yeah, got it.
Now, this is the data I got from the Federal Reserve site, where you can see the 10-year bond at the beginning of February was yielding 1.09%. And right now, which is 25th of February, just 25 days, the interest rates have gone from 1.09 to 1.54. Can you realize this kind of sell-off that would have happened in the bond markets?
Wow, no wonder people are starting to get really jumpy, yeah.
Yeah, because we saw the price dropped of those bonds from 1,000 to 962, which is basically a 38% loss. Imagine having a bond portfolio and saying that you have a 38% loss in bonds. That's a massive loss for the yields jumping from 1.09 to 1.54. This is because people are exiting these 10-year bonds in massive numbers, because they're watching. Probably these investors had a FOMO on stock prices going up so much, like they're missing out on a huge rally. That's the only reason you can explain why the bond prices yields have gone up so much, because people are dumping these bonds at ridiculously fast rates. Or they could be worried
going into GameStop.
yeah, or they could be worried that the government is now going to come up with a new $2 trillion stimulus, which means they have to borrow more $2 trillion at probably closer to zero, or even lower than 0% interest rates, real interest rates, right? So with all this borrowing, it's natural to expect that the governments are never going to increase the interest rate for a long time. So the bond prices generally should go up, but now we have a scenario where prices are going up so much. Even though J-Pow was saying I'm not going to increase the interest rates, he may not be able to hold on for much longer. He may be forced to play his hand and say, look, I'm increasing the interest rates by a 0.2% basis. Even a 0.2 basis point is a huge impact for the bond markets, like you have seen. So this would, if the bond market players have a loss on their bond portfolio, they're going to sell things where they're making a huge profit. So you can think from both sides of the table, saying you just said that rising yields is a good sign that economy is playing out well. Yes, in a normal scenario, yes, but not in a scenario where the yields go up from 1% to 1.5% overnight, So it's never good if things go up too fast, especially in bond markets. So, and especially, look, this is the current curve that we are having. 3 years have literally less than 0.5% interest. Longer term is commanding huge. The difference between the 1 years and 10 years and 30 years is huge. And this was in February 2020, where we had an inverted yield, where the 1 year had more risk. This is February 2020 because COVID, right? So people were more worried about long term than short term. So they jumped on to longer term bonds because they knew in the next few months hell is going to break loose. So the inverted yield is what you're seeing in February 2020. In February 2019, the curve was like this, where the difference between 1 month and 7 years was flat. You see, the flattening is the first sign that we could be entering a recession. And then you had inverted. And now you have a rising curve again. I'll show you from the past charts what this curve really does. This is basically the inverted yield curve, 10-year minus 1-year yield. So basically, you take the 10-year yield, which is say 1.5%, and you minus the 1-year yields, which is less than 0.5, and that is what you get inverted yield curve if you do a curve using those figures. The stock market, this is the various times where markets had a huge decline when the first yield curve inversion occurred, basically what we had in February. But inverted curve before stock market peak, no, there was still a good amount of time after which these signs occurred that the market actually corrected. So this, whatever is happening right now, is not a sign that the market will collapse right away, but the problem is we have already gone through the phase of inversion and we are now on the way up, and on the way up is where the actual recessions occur in the past, because you have stocks becoming entering into a bubble zone because everybody has dumped their bond portfolio and jumped onto stocks. So average lead time is around 8 months. If you compare from last February, we are on 12 months time frame, but that's just average figures, right? After the inverted curve has occurred, you generally the trend, the bottom or the bubble breaks close to 12-13 months post that period. You can see the yield curve. The Wall Street considers 10-year minus 2 years yield spread as the gold standard. So this yield curve went down, went below. This is the inverted yield curve, and when the inverted yield curve started picking up is when you had the recession. This is the crash in 1979, 1984, 90s bubble, 2000 internet bubble crash, and this financial crisis in 2008. And right now this chart is obviously low. This chart is slightly older. It's going back to 2019. The curve went down. Now this curve is actually picking up again. The difference between what a 10-year is yielding, 1.54, and what a 2-year is yielding, the difference is massive. Can you see 1.54 minus 1.17? The difference is 1.145 or something 4. So this yield has started to pick up like this. When this has picked up, like you can see from the past, that is where the recessions or the crash and historical crashes have occurred. Now this is the reason why most people looking at this whole curve as an indicator have started to sell stocks, even if it doesn't mean that the market has to actually technically reverse from this get-go movement. So it's a kind of paradox at the moment, because a lot of people are using this as an indicator to predict when the next recession is going to happen. So this is our present 10-year minus 1 year spread, which is again rising, which is not a good sign, because this is where the past recessions have occurred, like I've told you just in the previous chart. So we could very well be in few months, this could be few months from now. We don't know whether that's 1 month or 3 months from now, or even the month that we are in right now. So, and this is the 10 minus 2 year old, like again the second chart. Yeah, it's the same chart probably, yes. So this is our 10-year minus 2-year yield spread, which is 1.18 as per the last. I think this chart is few days old. Now this figure is 1.4. So the curve is rising too fast, and obviously we know that at least looking at this chart, the present future doesn't look too rosy for a stock market. That's pretty much it. So
I have a final question. With all this, at least for me, new wealth of information, I'm still trying to sort of digest as to, is there any way we can trade on some of these new things that we learned today? And that's maybe a question for the whole group. Like, has any of you any experience trading bonds?
No.
Yep. like obviously this is a more complicated field of subject and it requires more study before jumping on, but I certainly know that some of the trading platforms do allow you to trade US Treasury bills and other countries' Treasury bills futures. But obviously it's not the same movement that you expect in stock markets. The way things prices move is different to how stock prices react, like I showed you why. And just looking at the Excel sheet, just let me know if this Excel is visible. No, it's not. Stop.
No, we still see the slides.
Yeah, I'll share this Excel. Is it visible?
Yep.
Okay, let's say you bought a 1,000-year bond, and let's say now we'll take the maturity as 30 years, and let's say the coupon was 2% when you bought, and let's say you paid 1,000 for it, right? The effective yield is 2%, and let's say now the bond price falls to 900. What would be the yield? That's just 0.4%, 48% increase has led to a 10% loss in portfolio for this guy. Just 0.48% increase.
Yeah.
And if the price goes down to 800, it's just 1% rise. Just 20% loss. That's how a small movement in interest rates has a big impact for the big pension funds who hold massive amounts of bonds.
Yeah, very much over the long term. So it's the long term, the present value of money over the long term that's causing all that chaos.
Yep. So if I, as an investor, I'm thinking that the interest rates are going to drop, I will go buy this bond, right? So let's say my price of the bond goes up to 1,150. The interest rates have gone down from 2% to 1.39%. Now if the price of this jumps to 1,200, the real yield is now 1.2%. And let's say my real expectation is this yield is going to go to 0. So I'll say 1,500. Still the yield is 0.26%. Now this goes to 1,700. Now you have a negative yield, which is what the German yields are yielding at the moment. So you're paying 1,700 and you're only getting back 1,000 after 30 years, and you have a negative yield. But why people are jumping on to bonds which actually yield negative yields is because they still think that these negative interest rates is going to go lower and lower, and hence they have an opportunity to make money from here. So they think what the bond they bought at 1,700 can go to 2,000. 2,000. Interest rates can go to minus 0.89%. So this is why the reason is pension funds are still betting on bonds which are giving negative interest rates, where it actually costs them money to lend somebody money.
And my last question is these pension funds or institutions, how do they forecast or predict the interest rate?
Just like as we stock investors look at various matrices like company's balance sheet or annual results, what a company is doing and how its sales are looking for the next quarter. If I'm a bond investor, I would be looking at various other metrics. My metrics would be completely different from what a stock market guy will look at. I will be looking at the real consumer price index, like are the house prices going up, the real cost of living rising, what is the unemployment numbers, and so on. So based on these judgments, I will think that the economy is going to gutter in a couple of months. And I think the interest rates are going to go lower and lower from here because the government will be forced to drop the interest rates further. And hence, it looks good for me that I could go and buy the bonds at the present moment and expect to make good money. And imagine this is just from a scenario that I have $1,000 and I'm putting $1,000. People do this with leverage. Banks especially have massive leverage. So I could be literally buying a $1,000 bond by just putting $20 down. So you imagine what is the kind of move that $300 move in bond price is doing for your $20 investment. It's a massive percentage income. So that's how the bond market is actually a much bigger casino than stock markets.
I had one question.
Yeah.
So, in that slide where we had the inverted yield curve,
Mm-hmm.
and then we moved to the normal yield curve.
Mm-hmm.
So, if you go back to 2003, 2007, we had the short-term interest rates were actually increasing, which is why you had the whole inverted yield curve. And then, when the government finally, we had the financial market meltdown, and the governments had to bring the interest rates down. Therefore, the yield curve came down, and then from the inverted, it moved to normal. But in this case, isn't it different? Because uh, this time around, when we move from the inverted yield curve to a normal yield curve, it's also because we've just had a pandemic, which is kind of now getting back to normal life. So I mean, history never repeats itself. So I'm just trying to think that is it not possible that this time is different, mainly because your interest rates have even gone to negative, and you have so much liquidity in the system.
Yes, see, what this is basically different than a normal yield curve. This is a yield curve of 10-year minus 2 year. So don't confuse it with the same thing as.
So
Uh,
this one. So I was referring to this slide. Yeah.
yeah,
When we moved from the inverted to a normal. So
yeah,
back
see,
in 2003, 2007, it was different
no, see, this is
because
the data.
the
This is the data only from February 2019 to current. This doesn't have.
right,
Yeah.
but the next slide, this one,
Mm-hmm.
where we moved from inverted to a flat to a normal yield curve, it was mainly because and even interest rates that time were so high that when governments finally had to stop increasing interest rates, it was mainly because of the financial, the marketing, subprime bubble, and
Mm-hmm.
those things. But yeah, I mean, yeah. What am I missing here?
See, yes, this time is slightly different because you have a fact that there is inflation, huge inflation risk, but government is kind of really in a spot because if it increases the interest rates, it is affecting its own balance sheet because now it has to pay more interest on all the massive trillions that is borrowed. But nonetheless, what Wall Street is watching more carefully is not just the yield curve. They're watching the difference between this 10-year minus 1 year, right? Like I said, Wall Street's gold standard is not 10-year minus 1 year; it's 10-year minus 2 years, right? So when the yields of what you're getting for 10-year versus what you're getting for 2 year is going to a spike, going through a massive change, like it had in the past, that is when it has kind of signaled the crash or the recession because they all ran up so much and the government had to step in at some point of time before the crash happened, and eventually when the recession happened everything started going down. The stock markets and real estates, everything went down. So the Fed was forced to drop the interest rates again. So when you drop the interest rates, basically the yield comes down because the bond
Yeah, and
prices
so
shoots up.
right, and then they had to cut it further because we needed the excess liquidity,
Yes,
and because of the pandemic. And now they are kind of expected to increase, and that's why the yield curve's coming back to normal.
yes.
And
Now
so how it's
see now exactly what I said. Because the yield curve is rising, there is only so much Fed can try to step in. It can go and buy short-term one-year bonds to try to suppress this drop, to try to bring up the yields or the short-term bonds. Uh, but
so
even though
one
the
thing they can do is,
Mhm.
sorry, go ahead.
so
So one way they could do is raise interest rates, which they're saying they would not. So the second way is increase taxes on the wealthy, which is what the second probability is, which was expected in the uh, in the Biden regime, right? So that's the other way of cutting down excess liquidity in the system.
well,
And
wealthy will always have more ways to escape tax rises, right? So that's not obviously a good plan in any regime, be it Biden or be it Trump. This we're not really bothered about tax rises, but only thing is yes, even though Federal Reserve is saying he's not going to raise the interest rates in the near term, he will be forced to step in, maybe not now, but maybe towards the end of the year or start of the next year. So there is that risk, because stock markets are always forward looking. They're not looking at what is happening at the moment. They're forward looking. Now, because the prices have gone up so much, they went up so much because they all started expecting that things will open up and things will recover and so on. So it's always forward looking. So they are expecting that, people are betting that the interest rates are going to go up from here for at least very short term period of time. And like I said, we don't know whether the history will repeat, and because this time is really different, but it does certainly put it at a risk. What I'm saying is, I'm not saying sell all your stocks or stay out of stock markets for the next few months or something like that. I'm just saying cover your bases and don't be too greedy in terms of your return expectations, because you know that there's a possibility that a lot of professional investors are expecting that there could be a real possibility of a crash from here.
Right.
Yeah.
The only thing that I think may be different this time is that in the last few times we had to pull back on we saw pulling back on liquidity. This time there's no pullback on liquidity yet. I mean, unless they actually raise taxes, and then that's a different point.
Yeah, I think I will try to cover as to how Federal Reserve is stepping in and doing things differently this time around than previous times, but probably that's a different session altogether, and I don't want to extend this way more than what has already happened, because this is one of the longest sessions we have had.
Thank you.
Yeah, if that's all, then I think we'll close it, and I have the recording anyway. So for people who missed out, I'll definitely take time to upload this one and the last session, and have a very good weekend. Enjoy.
Thanks, Ninja. That's great.
Thanks, Ninja. Great session. Thank you.
Bye bye.
Thanks.
Thank you.